Hello, and welcome to episode number 4 of the Novice to Pro series. My name is Rufas Kamau, market analyst with FX Pesa. So if you have any questions, feel free to type those questions in the comment section. And at the same time, I would like to begin by doing a mic test. So you can hear me clearly, kindly type hi on the live chat, and these will confirm that everything is working just fine. Hello, Salva, and welcome to the session. Hello, Bernard, welcome to the session. Awesome. So let's proceed. So today is the 4th episode that we are doing in this series. So for those who are new or just joined the session, you should know that we have done 3 prior episodes. The first one is Introduction to Trading. The second one was Charting Skills. The third one, we focused on tradable assets. And today, being the 4th episode, we are focusing on knowing your candlesticks. So today is all about the candlesticks, knowing what they are, how they work, and how you use them in your trading. So in this series, it's designed to make you a professional level trader by focusing on the most important learning points, right from being a beginner to a point where you'll be a professional level trader. So a quick disclaimer, this is not investment advice. If you decide to trade, you should do your own research, do your own practice, understand how the market works, do your own risk management. So today it's only educative, help you build on these concepts, gain the skill, and start trading yourself. So now that that's behind us, let's go right into it. Let's start with the chart here. So I am using the MetaTrader 5 trading application. This is the trading application that you use in your trading. So if you're very new, you don't know what this is, and then you should probably go to episode number 1, go through the introduction, and then it will lead you to this point. So let's start right away. So on this particular chart, you can already see that these are red and green bars, and this is what we refer to as candlestick bars. So on the trading platform, there's 3 main charting types. One, we have the line chart, a very simple to read chart that gives you a little bit of information about what's happening in a market. So for instance, in this particular currency pair, we are focusing on the New Zealand dollar traded against the Canadian dollar. So on one side, you can see the changes in price, whereas on the other side, you can see the changes in time. So it's basically a chart of price moving over time. So it doesn't tell you a lot about what's happening in this particular chart. So we move on to the next charting system. In this case, we have the bar charts. So the bar charts are very close to candlestick charts, but they are not the best in terms of visual information. So we are going to focus more on candlesticks because they give you the best visual information about the chart, basically telling you what has been happening over time. So if you open your chart, customize, save your template, then they should get you to this right moment. Then from here, we are going to try and understand the anatomy of a candlestick, how it's formed, the major parts of a candlestick. And once we go through this, hopefully it will be easy for you to trade in the markets going forward. So remember, the candlesticks are the same. They obey the same rules. So you can practically use the candlesticks in all your trading. So it doesn't matter whether you're trading Forex, whether you're trading stocks, whether you're trading indices or any other stuff. The candlesticks will literally tell you the same information as we will learn going forward. So another thing to note is that there's another name for candlesticks. Sometimes they are referred to as OHLC bars. open, high, low, and close. Those are the short forms. So once you understand the OHLC, then you're able to use this information in your trading activity. So welcome to the session. Any questions, just type them. I'll be checking the questions moment after moment. Then hopefully we can make something productive. So let's start with a quick description of a very simple candlestick. So I'll be drawing a chart here, a very simple one to illustrate. So let's say that's our vertical axis and these are horizontal axis. So marking the movement of price over time. So on one side, let's say this is your price. Of course, on the chart, it will be on the far end, and this other end will tell you the time. So I'll be using a standard time for the entire presentation. So let's say we just call this time from the beginning of the day. Let's say session open. And this stretches all the way to the close of the session. So if you're looking at a line chart, and let's say you have price that is moving on a chart, and let's say price opens here, and then for the entire day, the price keeps on going up and up and up, and then crosses here at the end of the day. So the candlesticks will literally give you a summary of what happened within that particular period of time. So for instance, if the session was a day, so between the opening of the day and the closing of the day, you are only interested in the summary. And the summary has 4 prices. So you begin by looking at the first price. So the very first price is basically the opening price for that particular day. So we call this the open. So try and use a different color to illustrate the same. So not drawn to scale, just to give you a brief idea of what this is. So the closing price is also here. So if you check, the closing price is right here. So even if we draw a line here, it will just tell you the same information. So if I was to use text to write the descriptions, these would appear here as the open, and these would be the closing price at the end of that day. So price opened here, kept going up all the way up and closed here. So if you want to draw a candlestick for this, then you draw a very simple candlestick, and it would look something like this. So you'd have a green candlestick. So sorry, let's use the green color. So you would have a green candlestick that stretches from one end to the other. So notice that this candlestick is green in color. So the color coding basically represents the direction of price between the open and closing. So in this case, we can say that this is a bullish candlestick. So generally in the market, when something is going up, we describe that as bullish. If something is going down, then we describe that as bearish. So it basically tells you a very simple information that the opening price and the closing price are this distant. So this is the opening price and the closing price. And in some other candlesticks, as we are going to learn today, they might have tails. Tails represent the extreme prices within a particular period of time. So we might have an upper tail representing the highest price, and also a lower tail representing the lowest price we reached within that particular period of time. So in this case, it's a perfect scenario where the opening price is equal to the lowest price for that period, and also the closing price is equal to the highest price for that particular period of time. So let's try and do something different, but in this case, I'll be a little bit faster. So delete the open and the close here, then we leave everything else as is. So let's try and draw something else. So price opens here at the beginning of the period, and then this price keeps trending downwards up to the end of the session. So in this case, you would have a similar candlestick, only that it's completely different. So in this case, the open is on the upper side, then the closing price is on the lower side. So for such a candlestick, of course, it would be the same size or similar in size as the previous one. The only difference is this one will not be green in color. These, in this case, will be red in color, indicating that the price went down for that particular period. So a candlestick would look like this, basically telling you that the opening price is on the upper side, which is here, which is equal to the highest price reached within that period. And also the closing price is here, which is equal to the lowest price of that period. So that's basically how you read your candlestick, in this case, when price is going down. So let's try and make this a little bit practical, and we go to the MetaTrader 5 trading application. So let's say we start with the Euro USD. Then we look at examples of the same. So I've highlighted a couple of candlesticks. So here is one. So in this particular candlestick, the green one represents a particular period of time where the buyers were in total control of the market and they kept pushing the prices higher. So at the beginning of this period, we have our opening price right here. So this is where the price opened for that particular period. Then the closing price was right here. So it's important when you're analyzing your candlesticks to focus on the time frame here. So notice that there are different time frames here. So depending on what time frame that you select, then you're going to see different information on the chart. So remember, the candlestick is nothing but a summary of the price action for a particular period of time. So if you want to see your summaries in 1 hour, then you select H1, and each candlestick will present a summary of 1 hour. So for instance, in a 24-hour period, let's say the 24-hour period is from the opening price here to the closing of this particular day, then you are going to have 24 candlesticks, each candlestick representing the summary of what happened for that 1 hour period. So if it's 4-hour candlesticks, then you would have, in this case, 6. So 4 times 6 would give you 24 hours and so on. If it's a daily candlestick, then you would have just 1 candlestick. So in this case, let's say if I select day 1, which is daily, then each candlestick represents the price action summary for just 1 day. And I'm hoping that that is clear. So the strongest bullish candlestick with retro or no tails to each end is described as a bullish Marubozu candlestick. So the strongest bearish one is often described as a bearish Marubozu. So here is an example. Very strong candlestick, price opens here, keeps going down and closes here, indicating strong or super strong, controlled by the sellers. So in this case, we call this Marubozu. So there are different types of candlesticks depending on the price action that happened in that period of time. So let's try and identify different types of candlesticks and how you use them in your trading. So let's remove these a little bit quick, and then we try and move faster this time. So there are instances where you'll be having different price actions. So of course, it's very hard to see price moving just sideways like that in a particular period of time, let's say a day or whatever the time frame that you select. So I'll try and get something that is more realistic. So sometimes if you're trading, let's say a stock or even a currency, price might open and then goes up and then down. And then you have a lot of activity happening, let's say within the day. Then the closing price at the end of the day is the same as the opening price. So in such a case, if let's say this is your trading, and let's say opening is very equal to the closing price, then the summary will have several things. So you are interested in knowing the highest price for that period of time. You are also interested in knowing the lowest price for that period of time, and also the opening and closing price. So in this case, if the candlestick has the same exact price for open and close, then there will be no body of a candlestick, and there will be 2 long tails on each end. So your candlestick will simply look like that. So the information you get from this is that this is the opening price. This is also closing price. The highest price would be indicated by the upper tail. So this is your high. And the lowest price will be indicated by the lower tail here. So for any particular candlestick that is telling you, let's say the open is equal to the closing price, then we tend to refer to that as a Doji candlestick. So these can be described as a Doji. That's the term that we use in trading. So a Doji candlestick is any candlestick where the opening and closing price are equal or very close to each other. So if it's a difference of, let's say, just one price point, then it's basically also described as a Doji. So we are going to meet a lot of Dojis in the market, especially in our trading. And the simple analysis or interpretation of a Doji candlestick is that the opening and closing price are the same. So it basically represents a period of time where there was indecision. Remember what we mentioned in the previous two candlesticks. If it's a strong bullish momentum, then it's a bullish. If it's bearish, then there's a big difference between the opening and the closing. But then, if the opening and the closing price are exactly the same, then it basically represents indecision. So, for instance, in this case, we say that for this particular day, neither the buyers or the sellers were in control of the market. So it was basically an indifferent particular session of trading. So you kind of process this information that way. So let's try another type of candlestick. So in this case, I'm going to use a very simple one. So let's say the market is just plain dead. Nothing is moving, right from the opening of the day to the closing of the day. So in this case, the opening price here would maintain the same way during the entire session and close at the same level. So in such a case, we just call this a 4-price Doji. So it will be just a very small line, and this particular line, still a candlestick, would be described as a 4-price Doji. So in a 4-price Doji, there is no movement, so it's a completely dead market for that particular period. So 4-price Doji. So in this case, it basically represents a period of time when there was a little or no activity. So in some other cases, you might identify a lot of movement. So let's see if you can do one here. So let's say we take a price here. So price opens here, keeps going down, and then goes up, and then down. And this is the kind of activity you are seeing, and price closes here. So in this case, we'll have a summary. Okay, let's put this item into the lower side. Then we do our summary here. So OHLC, open, high, low, and close. So that's our highest price. These are our lowest price. This is our opening price here. These are our closing price. So in this case, notice that the closing price is way higher than the opening price. So the candlestick is green, indicating that the price went up for that particular period of time. So in this case, from here to here, we have a bullish candlestick. But then when you check on the tails, you'll notice that the tail is a little bit way too long compared to the body. So in such a case, we describe these as a spinning top. So in a spinning top, you'd have a small body that is almost at the center of the candlestick and very long tails on each end. It represents a period of time when there was a lot of activity between buyers and sellers, and the slight advantage or the slight win is a small body. So the body is the solid part here of the candlestick, whereas these are the tails, sometimes referred to as the shadows. So in this particular candlestick, it's generally taken as a indecision candlestick or indifferent, basically implying that there was a lot of activity, but the win was not significant enough to establish a bias in the market. So this is what we call a spinning top candlestick. So there are different types of spinning tops. you can have a green one or you can have a red one. So a red one is where the price crosses slightly lower than the opening price. So you would still have a spinning top, even when, let's say, we remove these and these and these, and let's say we try and change these. Let's say the price crosses a little bit lower. So in this case, what would change is the closing price. So you would have a closing price here and still have the high price here, and it would be still described as a spinning top. So the only difference is now the candlestick would be red in color because the closing price is lower than the opening price. So let's say we use red here. So you'd have a small body here, and also the same concept applies for the tail. It's very long on each end, and it puts the candlestick almost on the middle of the candle. So in this case, here we have the high. So the open is right here. So our closing price is the lower end of the body. So these are close, and this is the lowest price for that candlestick. So those four prices form the summary of how that candlestick is formed. So when you're looking at the trading platform, you will not see this movement of the line here. You'll only get one candlestick representing the summary of what happened in this period. As already mentioned, the summary has four prices: the opening price, the highest price reached, the lowest price reached, and the pricing at the end of the session or the end of the period. So this is the closing price right here. So notice that the body always represents the difference between the opening and the closing price. So to put these in perspective, we go back to the trading application. So now if you just look at any candlestick and just scan through it, then you have an understanding of what happened in that period of time. So let's look at this example here. So this is a candlestick on the Euro USD currency pair. It's red in color, indicating that the price went down. So the solid body basically indicates the difference between the opening price and the closing price. So in this case, price opened here. The closing price is right here. And the small tails represent the extreme prices for that particular period. So this was the lowest price reached here. And the highest price reached here is right over this point. So four prices determine the size and shape of that candlestick. So as we proceed, if you have any questions, they are very welcome. So feel free to type those questions in, and I'll be responding to those questions as we proceed. So all your questions about candlesticks are welcome, and I'll be responding to them on the go. So now that we have seen how a candlestick is formed, different sizes and shapes, then it's time that we cover different types of candlesticks. So you don't need to memorize the candlesticks and their names. What you need to understand is the price action behind them. So for instance, if you look at a candlestick such as this one, it's described based on its shape. We basically call it a cross. So in a cross, you notice that the opening is very close to the closing price, and there's retro tails on each end, which makes it to have a very simple description of a cross. So it basically represents a period of time when there was a little or no activity. And at that period of time, neither the buyers or the sellers won the tug of war. So in this case, it's considered as a very neutral kind of candlestick, indicating low volatility in the market. So remember, the candlesticks are relative. So when you're comparing the sizes, it's one candlestick compared to others to see whether we have a huge body or a small body, a big difference between the tails, or a very small difference. So the difference between the highest price of a candlestick and the lowest price of a candlestick is often described as the range of the candlestick. So a range of a candlestick would basically take the highest price of that candlestick and then compare that with the lowest price. So for instance, for this particular candlestick, we can say that the range is from this level here up to this other level here. So this shows you the range of that candlestick. So for a much smaller candlestick, you notice that the range is also similarly smaller. So let's do an example here for a candlestick with a much smaller range. So let's say we use this one. So we have the high and the low for the candlestick here. So let's try and change this. So these are candlestick here. So if you try and estimate the range, then it's this point down to this point. So a very small range of the candlestick. So notice that the range changes. So one candlestick can have a low range and another one can have a high range. So it's relative, you're just comparing candlesticks with each other. So if a candlestick has a low range, that is the difference between the high and the low, sometimes it's just described as a low bar. So yes, it's a candlestick bar. So if you just remove the word candlestick, then you're left with bar. So you can have a low bar and also a high bar. So a high bar is basically a high range bar and a low bar is a low range bar. And if you say it in full, you have a low range candlestick bar, high range candlestick bar. So when you're doing your analysis or looking at other traders in the market, you just use this short term. So you'll hear these are low bar, these are high bar, and now you understand what it means. So that's one of the very basic concepts that you need to understand about candlesticks. So moving on to the next shape. So you might not be able to cover all the shapes in one session, but at least you get an idea of how the candlestick is formed. So when you see a candlestick, you're able to understand the movements between the high, low close of that particular candlestick. So let's look at a very common candlestick that we tend to describe as a pin bar. So let's say price opens high, and then goes down for a particular session, then picks up and moves in the opposite direction and crosses very near the end or the open of that candlestick. So in this case, we do the summary as usual. So you start with the opening price. So this is how you do the summary. Of course, you'll never find yourself drawing this. So you are just trying to understand what this means. So open high, the closing price, and also the lowest price here. So here we have 4 prices marking our candlestick. So now if we draw our candlestick here, the closing is lower than the open, so it's a red candlestick. Then we draw the body here. So the body will just be from this point to this point. And then you have our tail extending all the way down, the low of that particular period. So try to make it centered. And now our candlestick will look like this. So we often describe this particular candlestick as a pin bar. So in a pin bar, there's several things to observe or to understand. So at the very first part of the session, there was a very strong bearish momentum. So sellers were attempting to push the market down or in control. Then the buyers came in and pushed the prices back up, closing very close to the opening price. So in this case, there is an interpretation that there was a change of control here. On one side, the sellers were controlling the market. On this other side, the buyers were controlling the market. So the long lower tail basically indicates a rejection of lower prices. So sometimes you will see some analysis describing this as a rejection zone. So a price where lower prices were rejected and price moved in the opposite direction. So sometimes when you are trading, this might be an interpretation that lower prices were rejected, and sometimes even a signal that prices are expected to continue going up, because now we are looking at a market that is being controlled by buyers. So remember, the second phase of the candlestick is buyers controlling the market. So immediately after the close, as we move on to the next candlestick, you might expect the buyers to continue pushing the prices higher. So you will see a lot of these candlesticks in the course of your trading, and learning how to understand how they are formed gives you an advantage of interpreting the information presented by price. So you can also have a pin bar that is green in color. It can also be the opposite, the body on the lower side, tail on the upper side, but the interpretation is very similar. So let's try these again, but now we do with a bearish pin bar. So in this case, price opens low. So we are just doing the opposite. So something rough, price goes up, and then goes down, and then closes here at the end of the day. So now, when you're doing your summary, as usual, you've mentioned 4 prices. So that's our opening price. This is our lowest price here. Sorry. So not drawn to scale. That's the closing price, and this is the highest price. So of course, the closing price is higher than the opening price. So we have a green body or a green candlestick. So you'd have a solid body showing you the difference between the opening and the closing price. Then you'd have your tail extending from the lowest price to the highest price. So try to center this, and the candlestick will look like this. So the idea is that for a good part of trading for that particular candlestick, the buyers were in control and they attempted to push the price up. Then somewhere within that particular period of time, sellers came in and drove the prices down. So it might be assumed that the sellers are still in control and they might continue pushing the prices down lower. So that's basically how you interpret this particular candlestick, with the very edge here being understood as a rejection zone, an area where higher prices were rejected and the sellers came in control, pushed the prices back down. So even though there is a slight win and the market closed higher than the open, the candlestick longer tail to the upper side is very significant, and it shows you the activity that was happening, giving you an idea of how to expect price to move, let's say, the preceding candlestick. So we go forward. So awesome. I'm seeing out of responses here. So just checking this quickly. So it has been hard for me to connect MT4 app with the FXPesa and assist me. So this is something that I'll be looking to address right after this session. Are candles enough to decide a trade? Yes, sometimes they are just enough. They tell you the right kind of information that you can use in trading. So I didn't know such information. Amazing way to understand the market. Thank you for the response. So not a single questions about candlesticks. So I'm hoping you're grabbing this information well. So we have seen how those candlesticks are formed and how you use them. But now let's get a little bit practical. So when it comes to trading, sometimes you may not just make a judgment based on one individual candlestick. So of course, over time, remember the candlesticks are formed as a summary. So let's say you're trading on the daily chart, and this is AUD/USD. So try to clean my chart here. So the exchange rate between the Australian dollar and the US dollar. So this is the current candlestick here today, representing the price at the opening of the day, the highest price, the lowest price, and this is the current price. So of course, yesterday the market was closed. It was Sunday, so this was Friday last week. Price went higher. Thursday was a higher movement. Wednesday was higher movement. Tuesday was downwards, and Monday was upwards. So on a daily chart, you're able to visualize this information all the way through the past, and you can tell exactly what happened. So for instance, in the month of June, price opened here, went to a high of this point, kept going down, and closed here at the end of the month. Then in July, price opened here, went up, down, up, down, up, down, all the way up and closed here. And now in August, price opened here, went all the way down, and then up, and this is the current price today. So it's very easy to read these candlesticks. Mostly, or most of the time, the closing price of one particular period will be the opening price of the next. So if price opens here, and let's use the red one, the big one here. So price opens here, there's no high, open is equal to high, goes to a low of this point, closes here. The next candlestick opens here, goes to a low, a high, closes here. So the close becomes the open, open, then the close becomes open, close, open, close, open, close, open. So it's very easy to read these candlesticks and know what happened in the past. So a common beginner mistake, they'll see red candlesticks and think this is a sell idea. Maybe I should be selling. Sometimes they'll see green candlestick and think, oh, I should be buying. No, that's not how it applies. Only a summary giving you a description of what happened within that particular period of time. So for instance, here you're able to follow the performance of the AUD-USD currency pair, the first hour of the day to the second, to the third, fourth, fifth, sixth, seventh, all the way to the current hour. This is the 21st hour of the day. So it makes it very simple to understand price movement. So when you're trading, sometimes you can't make a conclusive decision about one particular candlestick. So in this case, you look at pairs or even groups of 3 candlesticks. So there are specific patterns that we use in trading that tend to happen over time, and they give you a certain idea of what has been happening in a particular price action. So let's look at an example of a pair. And of course, you're going to learn more and more pairs, which you cannot possibly cover in one session without doing, let's say, 2-3 hours in one session, which would be too lengthy. So I am going to divide my chart into two periods here. So let's remove the session open and the session close. In this case, we do 2 distinct sessions. So let's say the first session ends here, and the other session ends here. So now you can combine 2 periods and then look at the price action for those 2 periods. So in some cases, let's say before the session started, price was on a downward trajectory. So price opens here, let's say goes up a little bit, and then keeps going down, and then back up, and then crosses here. So the next session opens here, price goes down a little bit, and then goes up, and then crosses here at the end of the period. So now you'd have 2 distinct candlesticks. So let's try and look and understand the sizes and the shapes of those candlesticks. So from here, you have the first candlestick, that's the open, we have the high, you'd have the low price here, and also the closing price here. So since the closing price is lower than the open, it would be a green candlestick. So let's look at these. This point down to the closing price, that's the shape of the candlestick. Now, of course, we have 2 tails here, one tail extending from this end, and then this other end. So clearly, it's not green, it should be red because of the closing price, which is lower. So I'm going to try and redo this. So between the opening price and the closing price right here, so red in color, we have our tails extending from each end. So that's a bearish candlestick. Apologies for that. So on the other hand, once the candlestick ends, you need to open another one. So let's say look at the opening price here. So the next one opens right after the close of the previous one. This is the closing price for the candlestick. This is the highest price. And this is the lowest price for the candlestick. So when you look at the body, in this case, it will be green in color. So the difference between the closing price and the opening price, in this case, will be in the opposite direction. So we do a green rectangle here. Then we add the tails from one end to the other. So sorry for that. So I hope this is a little bit accurate. So it represents 2 periods. So the first period was going down. The other period, the price is moving in the opposite direction. So The first candlestick indicates a period of time where the bears are in control, and then they keep pushing the prices down. So if you're trying to interpret this, you can see the movement here from the open to the close of the period. Then in the next candlestick, price picks up and moves in the opposite direction, but then the body is way stronger than the previous candlestick. So in this case, the interpretation is that we have a bullish engulfing. So in the bullish engulfing, we compare the bodies of the two candlesticks, and clearly the green one is way stronger compared to the red one. So if you were to think about this logically, you would say, let's say in the last 1 hour, price was going down, but then in this period, price went up, but significantly stronger than the previous one, indicating that the buyers in this market have taken control and are moving the prices better than the red ones. So in this case, it's taken as a bullish reversal pattern. So you expect that after this particular candlestick, price has a higher chance of moving towards the upper side. So you expect that immediately after this, you could see the prices moving in the opposite direction. So for most of the patterns that we are going to be focusing on as we do more and more analysis, they'll be trying to take concept or to understand the reasoning behind price action and how you interpret this information. So notice that period one, let's say on day one, price is going down. The following day, it completely reverses the previous day's movement, and then makes a step higher than that, basically indicating that the reversal move was stronger than the original move where price was going down. So in this case, we call this a bullish engulfing pattern. So try and type here. So this is a bullish engulfing. So the opposite of this is often described as a bearish engulfing. So let's see if you can identify examples of these. So I'm just going to do a very quick scan in the markets. So here's one. It's called a bearish engulfing, often very common when prices are reversing. So notice in the first instance, we have the trend or the general direction of price. So sorry for that. So here, the price opens in a bullish momentum. So notice, right, since morning, this particular price was just going up and up, forms the first candlestick, which is green in color. So for that particular hour, price opened here, went to a high of this point, closed here. So next point, price opens here, goes to a high of this point, and then a low of this point closes here, indicating that there is a very strong entry by sellers pushing prices in the opposite direction. So in such a case, we describe these as a bearish engulfing pattern. So in a bearish engulfing pattern, you can see that the body of this candlestick completely engulfs the previous candlestick, indicating a very strong entry by sellers pushing the prices towards the lower side. So immediately after the formation of the pattern, you expect that the sellers are still in control and they might continue pushing the prices lower. So it's often taken as a bearish signal, indicating that the sellers have entered and they could continue pushing the prices down. So whenever you are trading, you try and interpret this price action behind the candlesticks and then use that when you're making your decisions. So of course, there are so many patterns available in the market. We also have the morning stars, the evening stars. You're going to cover all that, but now you understand the reasoning behind these candlesticks. So let's take a morning star, for example. This is a morning star kind of candlestick pattern. So one of the preconditions is that it happens on a bearish momentum. So the general trend or the general movement of prices downwards. The first candlestick in the pattern is bearish, indicating a downwards momentum. Then the second candlestick has a small body, and notice the small body here. So it doesn't matter whether it's green, black, or red. The black would be neutral, green, bullish, red, bearish. Doesn't matter as long as it's a small body. So if it closes within the previous candlestick better, then the third candlestick is moving in the opposite direction. So if you try and interpret these in terms of the naming, these being a morning star, you would have endured through a long night. The long night would be, let's say, descriptive of bearish momentum, price continually moving down. And then before the break of the day, you get a small star in the sky. So the small star is symbolic of the small candlestick with a small body here. Then you get the bright morning with a strong green candlestick in the opposite direction. So you often compare the third candlestick with the first. So if they are the same size, or if it's taller, then the better. So after this pattern is confirmed, then we take this as a signal that the market has changed direction, and now you expect the price to start moving in the opposite direction. So that's basically how you try and interpret these particular sets of candlesticks. So you're going to see the morning star. The opposite of it is an evening star. So the evening star is very popular, very common in the charts. Here is one example. You don't have to search much. So initially, price is moving up for a day. First candlestick is green. Second one has a small body. Third one moves in the opposite direction. And the body is equal or taller than the first candlestick here. So in this case, we have an evening star indicating a rejection of higher prices, and now prices might continue pushing down. So immediately after the evening star, then you expect the price now to start going down. So a similar case here, notice it's also an evening star here, a set of 3 candlesticks. So price is moving upwards for a good number of hours. The second candlestick has a small body, third one in the opposite direction, basically forming your evening star. So we also have a bullish engulfing pattern here. So price is going down. The first candlestick goes down. Second one goes in the opposite direction, but the body completely engulfs the body of the previous candlestick. So you will notice a lot of these cycles happening in the market. The market is moving in one direction, forms a reversal pattern, then moves in the opposite direction. Forms a reversal pattern, moves in the opposite direction, reversal pattern, opposite direction, and so on. So that's why the candlestick patterns are so important in trading, because they can give you an indication of whether there is continuation or reversal of price movement. So of course, you're going to cover even more. So if you look at an entire list of all the candlesticks available, there is a lot more you can learn. So I will share a link. This is from a very popular website called Baby Pips. So from here, you'll get the entire candlestick cheat sheet. You learn the spinning tops for the Ming, the Dojis, the white Marubozu, the black Marubozu. You learn what a hammer is, a hanging man, inverted hammer. So the purpose of today's presentation was to help you understand the price action behind those candlesticks. So I will be sharing a link of the same with the live chart. So just in case if you want to go through them, then you will be able to learn what they mean and what they imply in your trading. So that being mentioned, we look at another key concept about candlesticks. And in this case, the focus is on where the candlestick pattern appears. So individual candlesticks or patterns can happen time and time again, but then where that, or the location where that candlestick pattern appears is very, very important. So of course, as we proceed with the sessions, we'll be covering market structures. So it will start to make more sense when we cover several market structures and you understand where you apply these candlesticks. So it's more or less like an introduction to the next session, which will be covering different market structures. So when it comes to application of candlesticks, you just don't want to see, let's say, bullish engulfing and say this is bullish, execute a trade. No, that's not how you apply it. So you have to look for the right movement to apply your candlestick pattern. So for instance, let's see if you can identify a market with a good pattern, and then you start to our advantage here. So I'll be doing this in hindsight. Remember, for you going forward, you'll be looking to do this in real time, not in hindsight. So I'll be drawing a small trend line here, connecting the highs in the market or the series of highs in this particular market. And I'll explain. So the highs represent a ceiling or what we describe as the resistance in the market. So initially price was going up, hit a resistance here, went down for quite a number of hours and then back up, failed to break this high the following day, kept going down and then up and then down, up and then down. Went back up to the same level. Notice the strong rejections here, where the tail goes through the trend line, breaks, and then moves in the opposite direction. So goes back up and then up and up and up and up and so on. So the idea is that if you're using support and resistance levels, these support and resistance levels tend to repeat themselves over time. So price will tend to behave in a similar way at a support or a resistance level. And you can use that to your advantage in speculating the price or the area where price might change direction. So you can notice these areas around the trend line here. So it's not drawn to scale, it's an area of best fit. So when you are trading using, let's say, a trend line, and you understand that there is a ceiling or a resistance that has been presenting itself along this line, then when price gets to such an area, you can easily predict where it will go next. So for instance, in this last point here, you notice that price hits a bottom here, goes back up and then down, crosses here for the day. So the following day, price opens here, goes down, and then all the way up, down, and then eventually gets to the trend line. So you know that for the first sequence, apologies, you remember the elections were announced today. So there's a lot of guys celebrating in my neighborhood. So I hope the noise is not too much. So you have identified the first point where the price was going up. Sorry. So gets here, fails to break, and moves in the opposite direction. And this becomes a theme every time the price gets to that resistance level. And that's how you identify that this is a trending resistance level. So let's use this. Then you use the other instance where the price gets to the same level, a strong rejection, and it moves in the opposite direction. So now you understand the theme in this market. You understand that there is a very strong behavior around the trend line where the price tends to change direction once it gets there. So if you're trading in such a market and now price is headed there, you have an expectation. You know that things could change and price could hit here and start moving in the opposite direction. So the moment the price gets here, notice that we have a spinning top kind of candlestick. So in the spinning top, there is a strong rejection of price here, but also there is a longer tail towards the lower side, indicating that you have an indecision in this candlestick with a green, small body and long tails on each end. So you understand there was an attempt to push prices up, and also there was an attempt to push prices down, but the cross is very close to the opening price. So on the next candlestick, it becomes similar or close to what you call a shooting star. You have a small body and a long upper tail that penetrates through the resistance. The resistance is the blue line of the ceiling. So the hitting of this ceiling basically indicates we have a rejection zone. So in this case, you would say that the area on the top of this candlestick is a rejection zone. And now you are building a case that sellers have entered this market and now you're looking to go short or go for a short selling trade. So in this case, immediately after the formation of the candlestick at the resistance, you might want to wait for the next candlestick or enter a trade immediately and trade towards the lower direction. So this is debatable. Some traders, they will wait for the next candlestick, while others will just wait for enter directly going in the downwards direction. So that's basically how you analyze some of these resistance and also the candlestick patterns and where they appear. So sometimes the area where the candlestick pattern appears will be very important in making a decision whether, let's say, to go for a buy trade or even to go for a short selling trade. So let's see if you can find an example here. So I'm trying to just scan the market quickly and then see if there's a theme that has repeated itself over time and how you can use that in your trading. So can't seem to find a lot of those. Sometimes when you're looking for something, that's when you don't find it. All right, so we have an example here. So I want to highlight this particular part of this chart, try and thicken my line. Sorry for that. So yes, here you have an example. So it's a clear theme in this particular chart that once the price got above this area here, it went back down to this area and then up, down, up, down, up, down, then up, down, and so on. So you can see that there is some form of ceiling versus floor kind of trading scenario, where when the market gets close to this line, you can also adjust it a little bit lower, just get a little bit accurate. So every time the price gets to this line with the exemption of this area here, finds resistance and goes back down. And when it gets closer to the lower one, then finds support and goes back up. So if you used the first and the second point, let's say you find that this is your support area, market goes back down, finds support here and moves in the upward direction. Now, when it's headed here for the third time, and you observe your price carefully, you're looking for signs of bullish entry, signs that the buyers are entering this market. So if you identify the bullish engulfing on these two candlesticks, the first one being the red one, then the second one being the green one, then it's a very strong case that buyers have entered at a support level. So in this case, it might give you the idea of going for a buy trade, targeting the upper side. So that's one of the way you try and identify the candlestick based on where they are located on a chart. So notice what happens here. You have a shooting star. So the shooting star is the candlestick with a small body. Sometimes we describe this as a pin bar. So long tail towards the upper side, indicating a very strong rejection zone. And then immediately after this, price moves the opposite direction. So learning to praise these candlesticks where they are, understanding the price level is key to using them in your trading. So I am approaching the end of the presentation. So I'll be checking on any of your questions, try to respond to them. And once we are through with these, hopefully the next session is going to be more applicable, helping you understand where to trade and where not to trade. So we'll be looking at market structures that are formed as a result of a larger number of candlesticks. So we have seen a small number of candlesticks and what they mean and how you use them in trading. So we have seen an individual candlestick and how you describe it. Let's say a doji, bullish Markozu, spinning top, and so on. But then looking at the overall market structure. So in this case, the market structure is a range. A ranging market is a market that moves in a rectangle in a sideways manner. So we have seen that a pattern can appear at the edge of the rectangle and give you a trading idea. So there are more market structures that are formed every now and then, and you can always use these market structures to your advantage to identify the momentum and the direction that the traders are taking in the market. So remember, it's always never guaranteed. So if let's say you are trading bullish engulfing here, it's not always guaranteed that if you go for a buy trade, the price will go up. Sometimes a pattern will be formed and the market will still go in the opposite direction, and that's completely okay. So when you're trying to understand these candlesticks, you are trying to understand an area where you have a better probability of winning versus a probability of losing. So in this case, don't take them too seriously. Just understand the price action behind them, the kind of idea that you get from that price action, rather than as a rule where if this happens, then this. Doesn't work like that. Sometimes the probability that something does happen will happen, and also the probability that something doesn't happen will also occur, and that's completely okay in the markets. So looking at the last questions to see if there's any that I've missed. So no such questions. Awesome. So a good question, how much is starting capital? Minimum you can start with is $5, but I always advise someone to invest how much you have, not the minimum. So if you're comfortable trading with $100, then start there. If you're comfortable trading with $1,000, then start there. Different people have different perspectives and also different bottom lines. So thank you very much, guys. Thank you for your time. We'll be focusing more on resistance and support levels on the next session. We will look at more market structures and how you can use these candlesticks in combination with market structures to identify trading opportunities.